Welcome back to Markets and Economics. Today we will cover part 2 of our essential F&O trading guide. Welcome, sir. In the previous part, we covered the core risks and definitions, futures, options, and the physical settlement trap. Now, let's go deeper. Before we even trade, who guarantees these massive contracts will be honored?
That is a brilliant question. The entire system relies on a hidden institution, the clearing corporation, or clearinghouse. The clearing corporation is the vital middleman. When you buy a contract, and another trader sells it, the clearing corporation steps in and becomes the buyer to every seller, and the seller to every buyer. This system eliminates counterparty risk. You don't have to worry if the trader on the other side will default. The clearing corporation guarantees that every transaction is settled, ensuring market stability, which is necessary for high-leverage trading to function.
Okay, let's go back to the options premium, the price we pay. How is that price determined? I keep hearing terms like in the money.
That refers to the options moneyness. This is the relationship between the current spot price of the asset and the option strike price. This relationship tells us how much real value is baked into the premium. In the money or ITM, the option is already profitable if you exercised it right now. An ITM option is expensive because it has intrinsic value, real profit built in. At the money or ATM, the strike price is almost equal to the current market price. ATM options are the most sensitive to time decay, as they hold the maximum extrinsic value, or time value. Out of the money, OTM, the option is not profitable yet. OTM options are cheaper, but they are pure speculation, consisting only of time value.
That clarifies the cost. But as a buyer, how do I know the exact point where I stop losing money and start making a profit?
That is the most practical calculation you must know. The break-even point. For a call option buyer, you add the premium paid to the strike price. Break-even is equal to strike price plus premium paid. For a put option buyer, you subtract the premium paid from the strike price. Break-even is equal to strike price minus premium paid. You must hit this price at expiry just to recover your costs. Any movement beyond this point is pure profit.
We know implied volatility or IV tells us if options are currently expensive or cheap. But how can I tell if today's IV is actually high or low compared to the past?
You need to use two contextual metrics. These turn the simple implied volatility number into an actionable trading signal. First, IV rank. This compares the current IV to its high and low point over the last year. It tells you the IV's position in its 52-week range. Second, IV percentile. This is often a better gauge. It shows the percentage of days in the last year where the IV was lower than it is today.
Can you give me an actionable example of that?
Certainly. Let's say the IV percentile is 80%. This means that 80% of the time over the past year, options were cheaper than they are right now. High percentile. Example, 70% or more. Options are historically expensive. This is the time to look for strategies that sell premium, like writing options, to profit when volatility eventually drops. Low percentile example, 30% or less. Options are historically cheap. This is the time to look for strategies that buy premium, betting on a future big move because the initial cost is low.
This takes F&O from simple definitions to practical strategy. Thank you.
Remember, F&O is a professional market. By understanding the clearing corporation, knowing your break-even point, And using IV, percentile for timing, you move from simply guessing to trading with a systematic, professional approach. Always prioritize risk management over potential gain.
We know the option premium is affected by time or theta and volatility or IV. But when the stock price moves, how do I know exactly how much my option profit should change?
Very good question. That is where the option Greeks come in. These are formulas that tell you the sensitivity of your option premium to different market factors. We covered Theta, but let's look at the two most important, delta and vega. Delta, the directional meter. Delta is the most straightforward. It tells you how much your option price should change if the underlying asset moves by 1 rupee or 1 unit. Example, if you buy a call option with a delta of 0.60 and the underlying stock price rises by rupees 1, your option premium should gain rupees 0.60 multiplied by the lot size. It is your measure of effective exposure. Vega, the volatility risk meter. Vega is the measure of risk related to changes in implied volatility. It tells you how much your option premium will change if the implied volatility moves up or down by 1%. This is crucial for buyers. If you buy an option when implied volatility is high, and then the implied volatility suddenly drops, the implied volatility crush, your option premium will lose value dramatically, even if the stock price moves correctly. Vega measures that loss.
That covers theoretical risks. What about practical problems? What happens when I try to exit a trade quickly?
This is a major, yet often ignored, risk for beginners, liquidity risk and slippage. This is common in contracts that are illiquid, meaning they have very low trading volume, often far out of the money or OTM options. In illiquid contracts, there is a large gap between the highest price a buyer offers means the bid, and the lowest price a seller accepts means the ask. This gap is called the bid-ask spread. If you place a market order, an order to buy or sell immediately, in such an illiquid contract, your order will execute at the worst available price, which is often far from the last traded price. This immediate loss is known as price slippage or a high impact cost.
So, I lose money the moment I enter the trade. How do I avoid this?
Brilliant. You avoid it by trading only the most popular, high-volume contracts. Actionable advice: only trade F&O contracts that show high volume and high open interest. This ensures the bid-ask spread is tight, minimal, guaranteeing you a better, more efficient entry and exit price. Never chase cheap, illiquid options. The lesson here is: never risk your capital by trading in dark, illiquid corners of the market. Stick to what is popular and transparent.
We've focused heavily on the risk of F&O, which is necessary. But you mentioned that the original purpose of derivatives was not speculation, but hedging. Can you show a simple, practical ways an ordinary trader can use F&O responsibly, as an insurance policy?
Absolutely don't. Hedging is the only responsible way to approach F&O as a beginner. Hedging means taking an offsetting position, using a derivative to protect an existing investment against a potential price drop. Example: portfolio insurance using put options. Suppose you own 500 shares of a company long-term, but you fear a major market event next month. Instead of selling your shares and triggering taxes, you can buy a put option on those shares. If the stock price falls, the value of your put option rises, offsetting the loss in your shares. You pay the small premium, but you keep your long-term position secure from short-term fear. Another example: protecting against a market downturn using futures. If you have a diversified portfolio of shares worth, say, rupees 10 lakhs, and you believe the entire Nifty index is due for a sharp fall, you can short or sell a Nifty index futures contract. If the Nifty falls, you lose value in your shares, but you gain profit on your short futures position. This essentially insulates your portfolio from the broad market risk without forcing you to liquidate any stock.
That is a clear distinction. So, F&O can be a tool for capital preservation if used correctly, rather than just a tool for speculation.
Precisely. F&O is like fire. Useful for cooking means hedging, but devastating if used recklessly or uncontrolled speculation. Start by learning to cook, not to burn the house down. Discipline, position sizing, and hedging. That is the formula for long-term survival.
Thank you, sir. This has been the most essential, hard-hitting breakdown of F&O I've ever seen. Thank you for walking us through the complexity.
My pleasure. The key takeaway for everyone is simple. F&O is not gambling if you master the risks. Focus on managing leverage, understanding Theta decay, and never selling options naked.
And that brings us to the end of our two-part F&O deep dive. We covered everything from option mechanics to risk-defined spreads and the physical settlement trap. If you are serious about the market, this entire two-part series should be saved and rewatched. Thank you for watching. Please show your support by hitting the like button, sharing this series with any trader, and leaving a comment below, telling us which warning was the most shocking for you. And, if you haven't yet, subscribe and ring that bell icon. Until next time, remember, discipline over emotion. Trade safe.